So good evening. My name is Andrew. Thanks for joining us today. This webinar that we're having today is sponsored and brought to you by the Climate Witness Project. So on behalf of the Climate Witness Project, I want to welcome you. And again, thanks for joining us. So before we get started, just wanted to go through a couple of brief housekeeping details. Then we will start the webinar. So a couple of things, if you're not familiar with the Climate Witness Project, the Climate Witness Project is a campaign of the Christian Reformed Church Office of Social Justice and World Renew. And we are primarily set up to work with individuals, congregations, organizations, as they learn about the realities of climate change, as they learn to steward the resources that we've been given, and more importantly, as they find their voice to advocate for common sense climate policies. This is lived out in our 4 pillars of work, which is education, energy stewardship, worship, and advocacy. Today, we're having an educational event, and so we're excited to be able to keep offering these opportunities. So just a couple of other notes before we start. If you are not signed up to be a Climate Witness partner, we invite you to do so. We will follow up with everyone who has signed up for this webinar. And in that follow-up, you have the opportunity to sign up as a Climate Witness partner if you are not already. Another note that we want to make is that we want to have an opportunity for you all to ask questions at the end of the presentation. So we'll be leaving 10 to 15 minutes at the end for your questions. So would encourage you to put your questions in the Q&A function. So as we go along, you can just put your questions in there. During the question and answer time, we will do well to get your question answered as best as we can. I also mentioned that we'll be following up. We are recording this event. So if for some reason you are not able to stay with us through it all, or you have friends and family who wanted to join in real time but could not make it, we will make the recording of this event available to you as well. So you can share it with other people and help them get acquainted with this topic. So please stay tuned for the recording as well. The follow-up to you would also include relevant links that will be shared from this presentation. So you're going to have access to that as well. So before I turn it over to Kurt, I also want to acknowledge that we have our Michigan regional organizer, Steve Mulder, with us today. He would also be sharing some reflections and perspectives on sustainable investing as a person of faith and what steps he has taken to do that as well. So that would be included in our presentation for today. So we're excited to have a very holistic and comprehensive view today. So I will turn it over now to Kurt from ClearView Investing, and he will lead us through this presentation. Thank you so much, Kurt, for making the time with us today and giving us an opportunity to learn on this very important topic. So over to you, Kurt.
Well, thanks for having me, and thanks for all who have joined us. I'm very excited to speak on this topic, and always excited to share information with people that are like-minded about this topic. And I hope that when you're done watching this and listening, that you're excited about this as well. I think you'll find that directing your money, not only personally, but churches, institutions, and so on, is arguably the quickest and most impactful way to affect climate change and to address the issue of greenhouse gas emissions. There's a lot of other things, obviously, that maybe move more slowly than you'd like, trying to get laws passed, wondering if your recycling is going into the landfill or not, the expense of buying new vehicles and appliances and so on. But here's something that you can do that actually can benefit you while it benefits the environment. So it's a win-win situation. And in the few years that I've made this presentation or one similar, it changes all the time, but there's been tremendous growth and impact in a positive way on the environment. I've got about 14 slides. My goal is to get through them as efficiently as I can without rushing, so that they're is plenty of time for discussion and questions at the end, because I would think that this would raise some thoughts in your mind and some things that maybe need to be clarified. So hopefully we'll have plenty of time at the end to do that, and I'll have contact info as well. The first screen, I think, is my hope. It kind of sets the tone so that when you've got all the information that I'm going to present, you're asking yourself not why should I be doing this, but why wouldn't I be doing this? In you know, the short time that this has even been an option for investors, there's been tremendous growth to the fact that 36% of assets globally are invested using ESG criteria. I'm going to get to the terminology in a couple of screens, so I'm not going to talk too much about what ESG means yet. But in general, these are impact investments of some sort, and there's thousands of studies now that I see almost daily come out that show that the returns on these type of portfolios are at very least neutral, but normally positive or outperforming traditional portfolios that would not screen companies for their environmental practices or social practices and so on. And then companies that have strong environmental ratings are generally good companies anyway, which are the type of companies that you'd like to invest in. Because they're typically successful and return a good profit on your investment. And then there is a fiduciary responsibility. Interestingly enough, maybe I would say as recently as 5 years ago, as an investment advisor, we were not allowed to recommend these type of portfolios because a fiduciary has a responsibility to do what's in the best interest of their client. And there were some legal hurdles where we were not allowed to do that, but also there was a time when the returns were not as strong on these types of investments, so we were not allowed to make those recommendations. That's completely flipped over now to the point where it's almost shirking your fiduciary responsibility if you recommend a traditional versus the sustainable portfolios based on what I now know and some of the data that I'm going to share with you. The rationale would be to achieve long-term investment goals. You don't want to sacrifice your investment returns to do this, and you don't have to do that. And you also don't have to just designate a small pool of money that you're going to use maybe and start an account that's going to address environmental concerns. You can invest anything that you would otherwise invest fairly easily, as you'll see later, into sustainable portfolios and expect to achieve and reach your long-term investment goals. And at the same time, you'll be aligning those investment decisions with your values. Obviously, the goal is to preserve the environment, leave a financial and environmental legacy for future generations, and be a good steward of God's creation. Knowing that this is the Climate Witness Program, I know there's some that may argue that that should be first, but keep in mind this list is not in any kind of a ranked order. They all work hand in hand, and they can all be achieved equally at the same time. So that would be the rationale part of the equation. There's a very short history of impact investing. And if you feel like you've missed the boat, no, why haven't I done this? And why haven't I been doing this? You really aren't too far behind, or maybe some of you are already, but probably not for a real long period of time, because there haven't been really too many options until fairly recently. In the 60s and 70s, there started to be a little bit of movement just where investors didn't want to invest in companies that made weapons, for instance, or that dealt with South Africa in any way based on different social reasons. In the 80s, there were some environmental disasters that started kind of getting people thinking about sustainable investments. But then you'll notice that from 1984, when the Forum was formed, to 2006, when the United Nations finally spoke out, nothing much really happened. But the United Nations Principles for Responsible Investment was released. And when that happened, things started to move a little bit. And in 2008, Dimensional, I don't want to say that this is the first, but as a disclaimer, Dimensional Funds, or DFA, which you'll hear mentioned from time to time, is the company and the family of funds that ClearView has decided to use for sustainable portfolios for all kinds of different reasons, mainly the return on investment combined with the impact, the positive impact on the environment. But DFA launched a U.S. and International Core Sustainability Fund in 2008. Other companies started to follow, but it was more of a trickle. In 2012, the inaugural issue of the Global Sustainable Investment Review was released, and I think that's an annual publication, but it's kind of like the gold standard of statistics and data. And that really kind of would be maybe the date when things started to get rolling. So roughly 10 years ago, but the growth really hasn't happened until maybe the last 3 to 4 years. Although it has happened in other places of the world. I'm talking from a U.S. perspective. The U.S. has lagged behind and really started to catch up a little bit the last few years, whereas you'll see some of our friends from Canada I know are with us, that they are ahead of the game. Europe is ahead of us. We're starting to catch up a little bit, like I mentioned, but really not a lot going on until 2018, 2019, and then things have really taken off since then. As you can see, 30% growth in the past 2 years, and that would be globally. The terminology can be somewhat confusing, but almost all of those terms are used interchangeably, even though they might not necessarily mean the same thing. You hear green investing a lot, and that's an easy one because that's one that everybody associates with this topic. You can kind of ignore all the other ones, and you can get down to maybe sustainable and ESG, the last two on the list. Even though those are used interchangeably, sustainable investing is actually a part of ESG investing. And I'll talk about ESG on the next few slides as well. But ESG is a broader area, whereas sustainable would be the E part of it, the environmental part of ESG. Socially responsible investing is an interesting side note in the fact that a lot of people choose to do that, or a lot of institutions like to do that because they would address social causes versus environmental issues, and they would maybe eliminate things that they don't agree with, such as gambling companies or maybe pornography or alcohol or tobacco or guns, whatever it might be. You can invest in funds that eliminate those. That is also part of ESG, but the sustainable is our topic, and you hear ESG a lot more than you hear any of the other ones. That's become kind of the catchphrase for this whole area of investing. So what is ESG? In 2005, you can see the term was first used, and environmental is the sustainable part of it that's addressing environmental issues. Social would be the other area that I just talked about. And then governance, just in general, is how companies are run, how they're managed, the boards, and so on, how they treat employees, all those things that make a good company. So that one isn't really a specific area. That kind of overlaps into the other areas. Usually you're going to focus on the environment or on some type of social issue, and in our case it's the environmental ones. And so this screen gives you a little bit of an idea of what type of topics fall under those areas. The green is where we're focused, and as you can see, all of those issues relate to the environment. Our portfolios specifically address greenhouse gas emissions and more specifically carbon, but they do address all of those issues as well as other greenhouse gases, but they're very, very targeted towards cutting down and eliminating and not rewarding companies that emit large amounts of greenhouse gases to reward them with investment dollars. And it's making a big impact, and a rather sudden impact, maybe even quicker than I expected. The social, we talked about some of those kinds of things, and those are good causes. It's a little bit harder to be successful with those types of portfolios because many of those things that I mentioned on the last screen are rather popular, and so they're profitable. And therefore, if you take them out of an investment portfolio, you might not quite keep up with what a traditional portfolio is doing. And you'll see later that that's not necessarily true with the environmental. The sustainable portfolios are very competitive and oftentimes do even outperform. And the governance, of course, overlaps into all areas of a good company. Here's where our friends in Canada can pat themselves on the back. As you can see, a 48% two-year increase in Canada and a 42% increase in U.S. Now, it's hard to get just sustainable data. So this is ESG. This kind of covers the whole realm of environmental, social, and governance types of funds and portfolios and investments. But when you look at those types of numbers, that's a huge increase and has a huge impact, as you see later, on the behavior of companies that are either receiving investment dollars or being withheld investment dollars. Canada's done some things that maybe other countries haven't from a regulatory standpoint, industry being involved, and then also customer demand that have really triggered that sudden growth. And the U.S., like I said, is starting to catch up. But if you look at the last bullet point, the highest proportion of ESG assets, that's a large number of investment dollars that are invested towards some type of a cause, some type of an impact investment, whether it be specifically the environment or something else. That's a very, I think, impactful number. Europe has always been the comparison to the U.S. And I think maybe Steve might remember when we first started doing this, there was a huge gap between Europe and the U.S. And that gap is starting to close a little bit, and the U.S. is catching up. That's mainly been driven by institutional investments at this point. A lot of pension funds, endowment funds. You'll find a lot of the college endowment funds, maybe it was student driven, that they demanded that those endowment funds be invested in sustainable portfolios and funds. And so a lot of that was driven, but you're finding companies doing the same thing, and it's really leading to some exciting growth. So what does that mean? Well, when institutions and individuals become more aware of how they're investing, and the employers and shareholders also become more aware, then the companies are more conscious of their behavior. They want happy employees, and especially they want happy investors. That's what drives everything. And that's why this area can make such a drastic change, and has started to make a very sudden change in companies' behavior, because investors are demanding it. And we're seeing that boards are starting to lean more in that direction, and almost everybody now has an ESG policy. And you can find all those types of things when you go through companies' prospectuses and so on. But the result, the good result in practical terms, is that now advisors and investment managers have more tools. I might have mentioned just in the last 3 years, the growth. If you were to look to do this, especially on your own, 4 or 5 years ago, it would have been very difficult to find something that you could be confident was not only going to be a good, solid investment with good returns, but also have a measurable impact on the environment or whatever other cause or topic you're trying to address. So there are a lot more options, and that leads to some other things that you have to be aware of as this starts to grow rather quickly, but we'll talk about that a little bit later as well. Here are some pitfalls. I've got a lot of them on here, even though several of them aren't really issues anymore. I left them on here because this is what it looked like about two and a half years ago. This was a list of things that were really red flags, very difficult to work around. And now a lot of those have not become issues, or have kind of disappeared as issue. Confusing terminology, we looked at that already. And once you start reading a little bit and hearing a few things, you can kind of see when somebody's talking about ESG and when they're talking about a social type of an investment, or when they're talking about an environmental or a sustainable type of investment. So that's getting better, and a lot of those other terms are starting to fall by the wayside. The second one is still something you want to be very aware of, just like you would with your normal investments. You want to be well diversified. There are thousands of green funds or funds that they advertise themselves as being green or sustainable. And I would say in the U.S., I thought I just saw there's maybe 600 funds now that you could invest in. But just like with your regular investments, you'd rather have a well-diversified portfolio, not just have all your eggs in one basket or in one fund. So that's something that you want to be aware of, rather than just reading that, oh, this fund had great performance, and all of a sudden jump on board. You probably wouldn't necessarily do that with your own personal investments anyway, unless it was, for instance, like a total stock market index fund, and it's going to cover everything anyway. But diversification is very important, and if you get too narrow, you can get some really quick gains, but you can also leave yourself out there to some sudden losses. And that's become an issue, of course, in the last few months as the market has gone in the negative direction. Lack of objective information, that's starting to change. We're starting to see a lot more. You can find an article or hear somebody talking about this anywhere, anytime, any day now. And a lot of it is very well researched and very academically based. Inconsistency with ratings providers. There are 4 main companies that rate industries or companies on their environmental practices. And they all look at a little bit different things. They've become, I think, more standardized now, more reliable, and they're moving in that direction now that companies like Morningstar are getting involved, and some of the bigger ratings providers are starting to get involved in looking at this as well and providing their ratings. So that's an area that's clearing up quickly. A lack of a clear investment philosophy. I did touch on this a little bit. You may have a fund or an advisor or a portfolio that tries to address everything. They want to fix the environment. They've got all these social causes, and of course the governance, good companies. They want the E, S, and the G. Some of those work pretty well, not necessarily as well as if you focus on just specifically what you want to address, the issue you want to address. And of course, we're talking about environmental issues and climate change. So if you can focus specifically on that, then you can get better data. You can find out what you're actually accomplishing, and you can be confident that both your investments and your environmental values are being met with your philosophy. The next one is changing rather quickly, the regulation. It was kind of the Wild West just a few years ago. There really weren't any standards, and everybody could do anything they wanted, and that led to some people being taken advantage of. And that is being tightened up. The SEC has now gotten involved. I would imagine in other countries, the same thing has happened, and probably sooner than it's happened here even. And so that isn't a real concern anymore. The last one is certainly still a concern, the rebranding or greenwashing. You will find a lot of companies that realize that, hey, people want ESG, people want sustainable investing. And so we're going to take this fund and we're going to slap a green label on it. We're going to slap an ESG. This is an ESG fund. There are numerous times where funds have actually done that without changing the underlying investments or holdings at all. The fund simply got a different name, and really nothing else changed with the investment philosophy. That is getting cleaned up with the increase in regulations and the more consistency with the ratings and so on. But early on, and it's still happening now, you have to be careful, and I'll give you some tips on how you can do that and be sure that you're investing in what you want to be investing in, and that you're accomplishing what you want to accomplish with your money. This is going to be more specific. I'm not trying to promote anything that we do, but this is the data that I have available. So I'm going to just give you a sample of what types of impact you can have, both from an investment standpoint and from an environmental standpoint. The DFA portfolios that I mentioned that we prefer to use have outperformed the benchmark over a 13-year span. If you remember, they were formed, those first 2 funds were formed in 2008, and they've outperformed for 13 years. There's, I think, 3 more funds that have been added now to allow us to make a more balanced and diversified portfolio. There is a little caveat to that bullet point. The first 5 months of the calendar year 2022, that actually has flipped over. So the traditional type portfolios have outperformed slightly, not by a large margin, but have slightly outperformed. And the main reason for that is that the big oil companies and the natural gas companies are making record profits, and the prices, as you well know, are sky high, and those companies are not in our sustainable portfolio. So we're losing out on access to those profits. It was just the opposite when the pandemic hit in 2020, I believe it was March, and the market took a sudden steep decline for several months. And when that happened, the sustainable portfolios actually outperformed the traditional by a good 2% during that short, maybe 3-month span. And then when the markets were positive again, they continued to outperform. So this has been a little bit of an anomaly, but it's understandable because of the situation with the energy companies and where we are with that. That certainly isn't a long-term thing. That isn't going to persist forever. And when it does drop, in fact, I had a friend who just sent me an article, I didn't even have time to read it, about what's going to happen to people's investments when the price of oil and the natural gas drops or really loses ground as an energy source. And it's going to really damage some people who don't get ahead of the game and are proactive in moving their investments away from those companies. But right now, people and the companies themselves and shareholders are cashing in on that situation. This is the interesting part, and that would be a 79.4% reduction in greenhouse gas emissions intensity. That's measured in tons of carbon dioxide per $1 million in sales. So in these funds, they actually measure for every $1 million that are invested in one of the DFA funds, they measure and report annually what the reduction is, not only in current greenhouse gas emissions, but also in potential or future emissions from reserves. So you can see almost an 80% reduction in current emissions, almost 100% reduction in future emissions from companies that have those types of energy supplies in reserve. That is, I think, the key to what you want to be aware of when you are investing this way. Not that somebody says they're doing something, not that somebody says, well, we're going to do this, we're going to do that, and then maybe or maybe not, you don't really know. But if it's actually published in a prospectus, in a year-end report, where the percentages of these reductions are actually listed, that really gives you, I think, confidence that not only are you doing well with your investments, but you're also doing well with taking care of our planet. The impact is that the investment capital specifically, shifts from companies with the poorest environmental scores or ratings to the companies with the best scores. And this is another, I think, somewhat unique thing that dimensional funds does. When they screen companies, it's not an all or nothing situation where this company's in, that company's out. The worst rated companies are automatically out, and I mentioned some of those already. But a lot of companies are trying to improve. So what happens is the companies with the better scores are overweighted in the portfolio, and then it's a sliding scale. The companies, as their ratings go lower and lower, less of their shares as a proportion are held in the fund. And so it's an incentive for them to improve. As they improve their environmental ratings, then their exposure in those funds increases, and they're rewarded with more investment dollars. So money drives everything, not just in this situation. It's the quickest way to get action, particularly from companies, by either withholding or investing with them. And we're seeing that happen right on down the line. And then coal companies have been closing down at a rather rapid rate. That's a good result of this as well. I can't imagine any fund that would advertise themselves as green or as being sustainable having any coal companies as holdings in their portfolios. I've got a few articles, and these will be included when Andrew sends out the video, you'll be able to take a look at these. I'll just speak about them briefly, but the interesting one, BlackRock is the largest mutual fund company that there is, and Larry Fink is their CEO. And about a year, I think, maybe a year and a half ago, BlackRock made a commitment to go sustainable with their funds. And it's very interesting to note that if you can see the quote there, their focus on sustainability doesn't have anything to do with their concern for the environment. It's because they're capitalists and fiduciaries. It's bottom line, it's money. They know that going in that direction is going to be more profitable for them, and they are going to be as fiduciaries to their client, being held to that standard of doing what's in their client's best interest. And they, based on extensive research, decided that the way that they could do that and cover both of those areas is to move to sustainability. That really triggered a huge increase in sustainable investments and ESG investments in general when that happened, because BlackRock is a part of many, many people's portfolios. And so some of them ended up having sustainable holdings without maybe even knowing it, just because a retirement plan might have funds in there and so on. Some of the others are articles or statistics, and they're really kind of fun statistics. They're very encouraging and they're very exciting to read, because a lot of them have to do with the growth. A lot of them have to do with the impact. A lot of them have to do with the profitability. And they are very, but as you can see, there's 25 of them in the first article, 30 of them in the second article. And for the sake of time, I don't want to go through that list. When, if you are interested, you can do that yourself. One of the points that they do make is that, I think it's the last article where it talks about investing continued to soar in 2021. They did talk about some things that government could do to encourage even more, and some regulations. And we kind of took a step back the last few years to where there were even requirements where they couldn't be offered in retirement plans and so on. We're starting to move back in the other direction again. But there are some things, at least from a United States standpoint, that are recommended that maybe the government could do that would be helpful. And I think some of those things are very realistic and are starting to happen. So that's kind of the pitch, so to speak. Now, to put that into practice is, how do I get started? And this is a good spot for Steve to jump back in, and he's got a little bit of insight from his own personal standpoint that I'll let him share for a few minutes here.
Great, thanks, Kurt. Hey, I took a look at the participants. I see lots of friends from lots of different places, and just excited to be with you tonight and just kind of share my perspective on this. First, I just want to say a word about individual action on climate with my regional organizer hat on. There was some, I think it was Bill McGibbon, but I'm not really sure. I couldn't find the quote again, but it was something like this. Individual action is a great place to start with climate action, but it's a terrible place to end. Meaning everything that we do is important. So all these things that lots of us are doing, recycling and maybe trying to use renewable energy, maybe changing our diets, maybe, I've got an electric car, I've got solar panels on my roof. So I've been trying to take those individual actions for a long time, and they're all very important. And they're especially important because, as Catherine Hayhoe says, we need to talk about them. We need to say that, this is what we're doing. We need to share that with other people so that they can get on board too. But it's a terrible place to stop because there's so much that we need to do in terms of corporate responsibility and policy change, as well as just our own individual actions. So now let me take that hat off and just put on my regular citizen hat. So just so you know about me, I've got 3 daughters and 7 grandchildren. I worked in the corporate environment for about 30 years. When I worked in the corporate world, I had a 401k, like many people do, and I had some control over how it was invested. Mostly it was in terms of how risky it was, but I think towards the end, I was able to make some changes that, in my mind, made them more sustainable, the investments. But it really wasn't the highest priority for me, because I didn't think about that as such a key thing in terms of my investments. So I retired. That 401k became an IRA. I found a advisor to help me with that money. I turned it over to him. he invested it in lots of different funds that been invested in lots of different companies. So the diversification that Kurt mentioned. In fact, there were hundreds of companies. I was totally bewildered when I tried to figure out what I was invested in. But I also don't really have that much interest in it, to be honest. I didn't really track it day by day or any of that stuff. So I just thought, well, as long as the advisor says it's making money and it seems like it's doing okay, I'm happy. So then maybe it was about the first time I heard one of Kurt's presentations. I talked to my advisor and I said, I'm really interested in putting this money in sustainable funds. So funds that would be, divesting from fossil fuel production and investing in renewable energy, for example. And he said, well, I just don't have any way to do that. I just, here are the funds that I have and this is how it works. And, I talked to him about it a couple of times. And then finally he said, if you really want to do that, you need to find a different advisor. So I thought, oh man, that sounds like a nightmare. That sounds really complicated. I don't know if I want to do that. But I talked to Kurt about it. This is not an advertisement for Kurt, by the way, or Kurt's company. So lots of, like as Kurt has mentioned already, there's lots of other investors that do this kind of work. But I knew Kurt from doing these presentations, so I talked to him. And he said, it's really not that big a deal to move the investments over. In my mind, I was trying to balance a couple of things. I was trying to balance, what's my obligation to my kids and my grandkids versus the rest of the world, the most vulnerable of the world. So I don't want to, I saved really hard over those years. I always maxed out my contribution to 401k. I don't want to just throw that money away, but maybe I'm okay with sacrificing some profitability. But I didn't really have a good idea how much that would be. And so I also, I obviously didn't want to put myself in a situation where my wife and I had to be relying on our kids to take care of us later on if the money in the IRA ran out. Yeah, and also it'd be nice to have some money as a legacy for my kids and my grandkids. So I was prepared to make some sacrifice, but I didn't want to throw it all away. Well, then I was talking to Kurt, and as he's spoken earlier, it's not necessary to make a sacrifice. It's just the opposite. And so I did turn over all my money to a sustainable fund, operated by Kurt. And up until this year, the returns have been fabulous. So, if anybody's following the stock market, everybody's returns have been fabulous. But the sustainable returns were better than like an index funds or better than the market overall. Now this year, it's all going south. It's going the other direction. I don't see that as a disaster. That's a blip. It'll go down. It'll come back up again. But while it's going down, I've talked to Kurt about it, sort of in panic mode a few times, and he's talked me off the ledge and said, hey, you're actually, you are losing money. Everybody's losing money, but you're losing less money than most people are losing. So these funds for me have performed better than the overall market in a good market, and they've performed less badly in the current bad market. So as Kurt said, I think he described it as a win-win. So I'm very happy with what I've done with our investment. I feel good about it. I still don't track it. I still don't, look at it every day and try to figure out how it's invested. But I trust in the fact that, Kurt has said that these are all going into sustainable companies. And so I feel good that I'm doing the right thing by my kids and my grandkids, but also the right thing by the rest of the world's most vulnerable. I'm helping to leave a better planet for everyone and not make things worse at the very least. So that's my story.
All right, thanks, Steve. It's good to get a personal perspective, and thanks for the kind words as well. I think just to add to that, I want to just be perfectly clear that the portfolios that I've described, it's not a situation where we've taken out all of the really bad companies and then are investing everything in solar panels and electric cars and everything else. That's not the way this works. There are many, many, many companies that you would recognize in there as not being necessarily promoting anything to do with climate change, but what they all do is they all have responsibility for their greenhouse gas emissions, and by rewarding or taking away investment dollars from them, as I described before. They have a very strong incentive to change the way that they operate, and we're seeing that happen. So when you have sustainable investing here, yes, you could just take and invest your money, and I'll show you a couple options later on in a solar panel company or in a project of some sort, and that's okay too. In fact, some you can get a fixed return, which is pretty good. But this particular setup that we have is designed to change behavior and to encourage these companies to clean up their act, so to speak. When you look at how to get started, number 1 and 3 are actually very easy. 2 is kind of tricky. Number 1 would be if you decided I want to go all in on this, and yeah, I'm convinced, and then this way, if somebody were to call me and say that, or email me, you could literally in 15 minutes, depending on how long it took to enter the information, 15 to 20 minutes, have an account open and have it ready to be funded, either with dollars from a bank account or a rollover, a transfer of some sort. Literally 15, 20 minutes, you could have an IRA open, a Roth IRA open, a simple plan if you have a small business, a SEP IRA if you're self-employed, just a personal or a joint account if you have taxable, that would be more like a bank account, but it would be invested sustainably. College investing, you can do the same for college savings. Easy, quick, fast. It's just very, very clean and easy. Workplace investing, not so much, depending on what your investment options are. Some of you have a brokerage link option, and that would allow you basically to go on and have access to maybe 20 or 30,000 different funds. And if you did that, you could find some sustainable funds. You'd have to kind of make your own portfolio. But for instance, Vanguard and Fidelity, which operate a lot of the 401, 403 plans, have sustainable funds that have actually performed very well. It's hard to get environmental data on those, and then their holdings indicate, that they might still have some companies that we wouldn't necessarily want to have in a sustainable portfolio. But in general, if you have the option of just throwing your money into the target funds that your employer provides, or trying to put together a portfolio, you might be able to find, for instance, a Fidelity U.S. fund, a Fidelity International fund, and a Fidelity bond fund, and make a pretty nice portfolio out of it. If you don't have those options, you can certainly request it. Human resources oftentimes will listen to employees' requests and see if they can make some changes. It shouldn't be that hard to do at this point in time, because there are a lot more options available. And then if you're over 59 and a half, you can actually take an in-service distribution and take your money even if you're still working, and you can move that into an IRA and invest it any way that you want, with any company you want, any advisor you want. You can be out from under the umbrella of the employer plan and the options that they offer. So your age can work in your favor there. Churches and nonprofits are pretty easy. We've got several. One of our clients and a good friend of mine around here has a large church that has moved their endowment fund, I think, I don't know, maybe $5 million completely to sustainable. They might have, theirs might be more of an ESG, but anyway, it may have some social stuff in there, but they have moved their endowment fund into an impact type of an investment portfolio. And then the 403B plan is a really good way as well. You can have, I've got quite a few churches where the pastor's the only one that's in the plan, but if a church opens up a plan, then the pastor can invest any way he chooses, and you can put together a very good sustainable in fact, we can use the DFA portfolios in a 403B plan. We can use the dimensional portfolios in anything on this page except for workplace investing. And sometimes those might even be available, like I said, if you have a brokerage link to your options, but that's an individual thing, and that's something you'd have to check on. But 1 and 3 are easy, and churches are finding that it really promotes what they believe in, and to be able to say that, yes, our dollars are going, some pretty significant amounts of dollars are going towards taking care of the earth and so on, the environment. And then you can also say that, yeah, our workers are, I've got a church up north that in Michigan that I think has maybe 12 or 13 employees, everybody from the pastors right on down to the custodians and maintenance people, everybody in between. When I presented their options to them, all but one chose the sustainable portfolio, and the one person that didn't, I think, was getting some input, maybe some feedback from her husband at home, and went in the other direction. But most everybody went that route, and have been very happy to do that. So that's a pretty easy way to get started. And if you are going to ask somebody, an advisor besides myself, these are some good questions to bring up. Do you offer ESG or sustainable? That's the first question, obviously, that Steve asked. And then what is your firm's ESG sustainability investment philosophy if they do? Do you target the environment, greenhouse gases, or are you broader in your philosophy, or what type of funds are you using? Do you use funds versus portfolios? Will you put together a diversified portfolio? All of those things. How do you invest client funds within these portfolios? The portfolios I mentioned are mutual funds. Some have exchange traded funds, but they're basically no different than anything else that you'd be invested in most type of accounts. And then how do you measure results? I think this is the best thing. Anybody can get historical returns, how the funds or how the portfolio is done quarterly, or you can even get it daily now. Anybody can log on and get returns all the time, which is a little bit stressful sometimes, but at least annually, if you can check your historical returns and see how that's stacking up against the overall market, you can get a pretty good idea if you have a good portfolio. But then to be able to provide environmental data, I think that's where a lot of companies and advisors are lacking. They don't really have anything that says, hey, this is actually, we're investing this way, and this is actually what's happening because of it. When you put your dollars here, this is how much you're decreasing the carbon that's going up into the atmosphere, and by investing in these companies. So I think that would be a real good checklist to go down, however you choose to do this, if you choose to do so. I oftentimes have questions about green banking, and that's changed rather quickly as well. There weren't a lot of options. Now we've almost stepped backwards a little bit. We do have sustainable bond funds, and they're part of our portfolios, and you can find the Vanguards and the Fidelities and so on have sustainable bond funds, and those are funds that are lending money only to green companies, so to speak, or maybe those types of projects that impact the environment. So those would be funds are ways that you can invest, but banks themselves have had to back off of that. They were actually threatened when several of the big banks announced that they were going to back off and no longer lend to, say, fossil fuel companies and so on. There were certain senators and legislators in our country here that actually threatened retaliation against those banks, and they had to back off for the time being. But from a standpoint of personal banking, there are some ways that you can do that. First of all, if you are looking at a bank, and you can bank online, so it doesn't have to be down the block from you. You can bank anywhere you want nowadays. So one of the things you're looking for is a label B Corp bank. B Corp is just a certification that says that they meet the highest standards of verified environmental performance and so on. You can read that there, but it is kind of like a stamp of approval that these are environmentally friendly banks, and you will find some. I don't find a lot of the big name banks with this certification. They're oftentimes regional or local banks that you'll find. Another one that you can look for is GABV, the Global Alliance for Banking on Values. If you have these initials attached after the name of a bank, you can be confident that they're going to be using their finances for sustainable economic, social, and environmental development. And so that, just in general, if you are looking and analyzing some banks, those would be good things to look for. This is a link here that you'll be able to click on, aspiration.com. You can get a credit card that actually gives money for environmental causes, and actually tries to impact the environment that way instead of giving cash back, et cetera. They use, and there may be some more details to that. I know Steve is a little more knowledgeable about this than I am, but you can also have a bank account with them, and they're very, I think, specific on how they use their funds. The funds that you loan them do not go out to fossil fuel companies or just to random projects and so on. They are very specific in where they loan those monies out to. And then the Raise Green is actually where you can choose. If you click on this, you would find a list of 5 to 10 projects, say, that would have different criteria. And you could say, hey, yeah, this the city of so-and-so is going to be putting in solar panels, and we can lend them increments of, I don't know, $1,000 up to who knows how much, and get a guaranteed 5% return. So there are some fixed income ways, so that if you are leery of investing in the stock market and trying to impact your or direct your investments that way, you can also directly invest in projects, and some of them actually do give you a fixed rate of return. And then whenever I searched for green banking in Canada, Van City kept coming up. I don't know exactly, I don't know a lot about them, but they kept coming up on every single search. And what I read about them is that would be the top option, and they do online banking, so I guess it wouldn't matter where you are in Canada. You would be able to use their services for green banking, and you could research that by clicking on this link when you get a chance, but I won't do that right now. So there are options, and I think you'll find that those options are going to continue to grow as of the investment. The investment options have surged, but the banking hasn't kept up quite as much. But there's been a lot more demand for investment products and not as much demand for the banking. So it'll take a little bit longer for it to catch up. But I believe that concludes the slides I have. I will mention before I turn it back over to Andrew for any comments or discussion or questions that if anybody was interested in contacting me, there'll be no pressure. I'll have any kind of conversation with you like. I'm not going to give you any kind of a sales pitch to become a client or anything like that. I just want people to do this. But if you do choose to pursue and learn more about ClearView, there are some links there, and also about Dimensional. And if you did find that you like Dimensional, we are not allowed to work with clients in Canada, but I have quite a substantial list of Dimensional fund advisors all over Canada. I didn't publish them because I didn't have their permission to do so, but if you told me where you were located and wanted me to connect you with somebody, I would get their permission to do that, and you could have a conversation with them about the funds and the portfolios that I described. So that's, I think, the end of the useful information I have from the presentation. So I will turn it back to Andrew for any further conversation.
Thanks, Kurt. We actually have a couple of questions that have come into our Q&A function. I think you can also click that from your end to see that, but just want to have the chance to answer a couple of those questions. So one of the questions are, and again, you can see them from your end too, Kurt, but it says, as to an investment advisor's fiduciary responsibility to clients, my understanding has been that there is no legal requirement that investment advisors act in the best interest of their clients, but can, for example, recommend whatever investments will pay the biggest fee to the investment advisor. Is my understanding correct?
You're partially correct. I didn't get into that too much. When I talked about fiduciary responsibility, I was talking about the major companies like Fidelity, BlackRock, and an investment advisory firm. So in the United States, I'm not exactly sure of in other countries how it's regulated, but a registered investment advisory in the United States has a legal requirement that its advisors act in the best interest of their clients. However, the catch to that is there are thousands and thousands and thousands of people that dispense or that promote products, investment products that are not registered investment advisors. They are representatives of a brokerage or they are representatives of a company, and they do not have a fiduciary responsibility. Their responsibility is to provide a suitable investment for their clients. And that is a huge difference. So oftentimes a suitable investment could have a large fee attached to it. We've made every effort to reduce the fees as low as we possibly can. The DFA funds have continued to drop their fund fees and so on, and try to do it as efficiently as possible. But that is a great question, because who you deal with has a big impact on what their advice might be. In fact, a representative of a brokerage firm or of an investment company that is not a registered advisor, oftentimes, well, not oftentimes, they are not allowed to dispense investment advice. So what they're actually doing is they're sales reps. They are trying to sell you a product, and there's probably a financial incentive for them to do that. So very, very good question. And that's another, I guess I could have put that in the pitfalls section to watch out for when you're deciding who you're going to work with. So thanks for that.
Mm-hmm. Thanks, Kurt. Another interesting question is, the market has been tanking lately. So what is your best guess as to when to start making new investments in the market?
All right. Did you jump over the one above that? I can answer real quickly about.
I think the person who asked that said never mind to that. So
okay.
I moved to that. So don't worry. I will field the questions for you. Yep.
Okay, great. Very, very, very good question. If you were to have anything else that was on sale, you would be more likely to buy it when it's on sale than when it's at its regular price. So for those people that had to decide maybe 5 or 6 months ago to invest a large sum of money, my advice to them was, let's not dump it all in at one time. Let's feed it in there in smaller amounts, so that if the market does go down, which there were a lot of warning signs, that maybe then you can feed money in as it goes down and buy cheaper shares. So wealth is created when you can take advantage of drops in the market. And we've had a pretty big one. Now, have we hit the bottom? Who knows? Nobody knows. If anybody tells you they know, that they're lying to you. But we've had a significant enough drop when you talk about 20 to 30% in different sectors of the market, that shares of funds and companies are on sale right now. And so if you are going to make new investments, this is a great time to do that, because you are going to get a bounce at some point. If it's a bear market, you might be talking about 9 to 15 months. If it's just a correction, you might be talking about next week, a month or two. Nobody knows when it's going to, and I would not put myself out on a limb, but we do know that at some point the market will return to where it was. And if you dollar cost average money into the market, meaning you put it in smaller, say you have a chunk of money that you want to put in, maybe you break that up into 3 or 4 segments and deposit it every month and invest it every month. And then as you put that in, you're catching different price points. But as of right now, it's a very, very good time to buy, and you might jump in and it might go down another 10 or 20%, but it's a lot cheaper than it was, like I said, 5 months ago, and it will return a lot quicker than it would have when it was at its peak, just 2 or 3 months ago, before we really started tanking. So that's, again, another really, really good question, but it's kind of counterintuitive. People want to buy more when the market's going up, and they want to sell when it's going down, and that's exactly the opposite of what makes good financial sense. You don't really want to buy when it's going up, as fast as it did for a while last year. But when it's going down, that would be the best time to get involved in the market. Thanks for that.
Okay, so another question from our list. So what are the characteristics of dimensional funds that makes you recommend them?
Well, when we analyzed everything, all factors considered, we had worked with dimensional funds with their so-called traditional portfolios for years. That was kind of like, dimensional funds are kind of like, they're sort of like the holy grail of investing, because you can't just go online and invest in dimensional funds. You can't just access them with any advice. You have to go through a dimensional advisor. And so we had to go through quite a bit of training and so on to work with dimensional at all, but we had no idea. I had no idea about anything was sustainable. 5 years ago, 4 years ago, I'd heard a little bit, but until 3 years ago, when I really started researching it, I didn't realize that dimensional had sustainable funds. So then when I started looking at them, all of the other things that we liked about the funds themselves, their long-term performance, but everything's based on academics. They've got several Nobel Prize winners on their advisory board and so on, and everything is based on this Nobel Prize winning research. And we've seen that the way that they handle the funds, they're kind of like a juiced up index fund. They're not index funds where you just own everything in an index. They're kind of like semi-managed index funds. So there is some strategy to it, and they've done great with it. But what really finally sold us is when I clicked on the prospectus, and boom, right there was the data on the environmental impact. I had not seen that anyplace else. This is what's being taken out of the atmosphere if you invest this way. And so the combination of the performance that we'd seen over the years with dimensional, combined with the research that they were able to show us and the statistics they were able to show us on the actual impact that these funds were having on the environment, was the reason why we went in that direction.
All right. Just looking at our time here, I'll try and see if we can grab two more questions, but I definitely want to encourage folks that you can see Kurt's information. You are more than welcome to send him an email and direct some of the questions that, in case we're unable to address all of them during this time. So the other question is, if one invests on their own, is investing in an ESG index fund generally the best? Are there better ESG options for investing during a period of high inflation?
I'm not aware of any specific funds that would strictly deal with inflation, because you're trying to go for diversification, and if you're in an index fund, you're not actively trading those shares, so that you're not going to be reacting to different inflation reports. But I think, was this also the question about ETFs versus mutual funds, or is, I'm not sure. Oh, I might have skipped. I might be talking about a different question there. Did I answer that question, Andrew, or did I not finish up?
No, I think you did. So that one was a separate.
iShares are, yeah, I see iShares on there, something about that, and that is, they do offer sustainable funds. I'm not real sure about what they specifically address. So you actually almost have to look at a prospectus. It's kind of time consuming, labor intensive, but look at what the holdings are. Do they have any data on environmental impact, and so on? But the index funds that I'm aware of are the Vanguard and the Fidelity, and I know that they've performed well, but I'm also not an expert, because the only experience I have is that when I've helped people use those funds in their workplace investments. We don't use those for our own portfolios, but I have helped people find some green funds or some sustainable funds within, and I know that they perform quite well, and they at least advertise that they are environmentally friendly.
Yeah, I think this question might be helpful to address. Could you explain the difference between DFA funds and sustainable funds?
Well, DFA has a whole range of funds, just like Vanguard and Fidelity, but they have and they're all different categories: small companies, large companies, international companies, emerging markets, stock funds, bond funds, mutual funds, ETFs. DFA is moving more towards ETFs, and I don't know if they've done that yet with their sustainable funds, but they have this whole huge family of funds, and then within that family, these companies offer a small menu of sustainable funds which specifically address the environment. And like I said, those offerings are growing with demand, but out of Vanguard's, I don't know, thousands of funds, they've got 3 or 4 or 5 sustainable funds, and Fidelity's got 800 or 900 different funds, and there might be 3 or 4 sustainable funds. DFA has 5 sustainable funds, but they are very well diversified, so that with those 5 funds, you can make a really nice portfolio. But that's the difference. Yeah, DFA doesn't just specifically specialize, but what we've done, and I've found, just as a side note, a lot of the dimensional fund clients that I had that were in the traditional portfolios, when I explained the difference, I didn't know if they cared anything about the environment or not. But when I presented what I know about the 2 alternate portfolios, almost every one of them has chosen the sustainable, and almost every single new client that I've had come, and they haven't come to me specifically for, necessarily for the sustainable portfolios. When I explain the options, I think all but 1 or 2 have chosen to go the sustainable route. And so that's the difference. You've got thousands and thousands, probably 30 or 40,000 mutual funds just in the United States alone. And I think maybe 500 or 600 of them are advertised as ESG funds right now. So it's just kind of a niche is what it is.
Great. Well, I think that is our last question for tonight.